Want to start a startup? Easy. Come up with a genius idea. It just needs to sound futuristic, even if it's simple. Something like an AI-powered sleep ecosystem. Go to investors. The market is huge, no competitors. They give you money. Burn millions. Fancy office, marketing, hiring. Everything's going great. Then, boom, money's gone. Investors are pissed. Startup is dead. This story happens thousands of times. Companies valued at billions go up in flames, leaving investors with nothing. It's not bad luck. It's a pattern. Casper promised to revolutionize sleep. Juicero sold a $700 smart juicer, but people just squeezed the juice packs by hand. MoviePass offered unlimited movies for $10 a month and went bankrupt. Quibi burned $1.75 billion on videos nobody watched. So why do startups with tons of funding and big promises keep crashing? On paper, it all makes sense. There's a market problem, an innovative solution. Investors pour in cash. Customers love it. That's how it was supposed to go for Casper, the startup that promised to change the way we sleep. Mattresses suck. They're expensive, hard to choose, and salespeople push you to buy. Who wants to awkwardly lie down in a showroom and pretend they're comfortable? Casper had a simple fix. Sell mattresses online. No stores, no pushy salespeople, no extra costs. Shipped in a stylish box, 100-night free trial. Don't like it? Return it, no problem. Investors were skeptical. Who buys a mattress without testing it first? But in 2014, the startup secured $1.85 million before even launching. On April 22nd, Casper listed 40 mattresses, hoping to sell a couple in a week. Thanks to a media blitz, they sold out on day one. First month revenue, $1 million. The press went wild. The future of the sleep industry. Investors poured in. Leonardo DiCaprio, 50 Cent, Adam Levine. Casper hit the perfect wave. Warby Parker disrupted glasses, Dollar Shave Club changed razors, Glossier reinvented cosmetics. DTC brands were breaking old business models, cutting out middlemen, and taking over the market. Casper looked like the next big success. But there was one problem. Casper was skyrocketing, but money was slipping through their fingers. Investors demanded more growth and kept throwing money at them. August 2014, $13.1 million in funding, right after launch. January 2015, $20 million in sales. The brand was hot, marketing was working, and investors kept pouring in. 2017, another $170 million. 2019, another $100 million. Revenue topped $400 million. Valuation hit $1.1 billion. Retail giant Target even offered to buy Casper for $1 billion. The founders said no, thinking this was just the beginning. Instead, Target invested $75 million and started selling their products. But soon, it became clear. Growth doesn't equal success. $300. That's how much it cost Casper to acquire a single customer. And the profit from selling a mattress? Way less than that. Facebook, Google, YouTube, podcasts. Casper was everywhere. Flashy ads, celebrity endorsements, aggressive marketing. But the more Casper sold, the more money it lost. And then things got worse. Customers started returning mattresses at an alarming rate. A 100-night trial sounded great in theory, but in reality, it meant skyrocketing costs for logistics, returns, and disposal. Their attempt to expand into Europe? A disaster. Higher shipping costs, more cautious buyers. It all led to massive losses. By 2019, it was clear Casper was in serious trouble.
What? Revenue? No revenue. I'll call you back.
What?
Why would you go after revenue?
Because to make money?
No.
But they had one last shot, an IPO. When a startup runs out of cash, it has two options: find new investors or go public. Casper chose the latter. The plan? Go public, raise $100 million, and prove to the world that this wasn't a failure. It was the future of the industry. But investors started asking tough questions. Why were marketing costs so high? Why was a billion-dollar company still unprofitable? Why was Casper burning through cash faster than it could make it? No one had good answers. Then came the first blow: valuation cuts. Casper wanted to be valued at $1 billion. But once investors saw the real numbers, that valuation was slashed in half. Then again, and again. By the time Casper finally hit the stock market, shares dropped below their initial offering price. The media compared it to WeWork. Investors panicked and dumped their stocks. Casper's downfall wasn't just another startup failure. It was proof that rapid growth without a sustainable business model is a recipe for disaster. Bonobos, Allbirds, Warby Parker, dozens of startups made the same mistakes. They raised millions, spent it all on marketing, and then suddenly realized they were out of cash. Casper's collapse wasn't shocking. It followed the same pattern that had doomed so many before it. So what exactly went wrong? Let's break it down. Casper went all in on aggressive marketing. From 2016 to 2018, the company spent $423 million on advertising and another $114 million in 2019. They spent $300 to acquire a single customer, selling mattresses for $800. That meant nearly half of their revenue was eaten up by marketing, leaving razor-thin margins. Other startups, like Blue Apron and WeWork, also burned through cash on ads but still operated at a loss. When customer acquisition costs outweigh profits, the business is doomed. Casper, Away, Allbirds, these brands sell products people buy once and keep for years. Customers don't come back for repeat purchases, so the company stays reliant on expensive ads to attract new buyers. They tried expanding their product line, but it didn't work. Eventually, even Casper admitted they wouldn't reach profitability anytime soon. Startups love to claim they're disrupting retail, but then they end up opening physical stores. Warby Parker, Casper, Glossier, they all did it. But brick and mortar retail comes with cost: rent, logistics, staff. That's a tough hit for a business built on a direct-to-consumer model. Casper tried retail too, but it never became profitable. On top of that, they faced high return rates, leading to massive logistics and disposal costs. WeWork, Bird, MoviePass, they all scaled using investor money instead of real revenue. Casper followed the same playbook. But when the cash flow slowed, it became clear they couldn't sustain their growth. Casper, Peloton, Blue Apron, these startups had sky-high valuations before going public, only to see their stock crash. Investors are happy to fund growth, but the market demands profits, not just hype. From day one, Casper targeted a young audience, one that wasn't necessarily the most financially stable. On top of that, one of the founders was notorious for aggressively fighting negative reviews, which hurt the brand's reputation. But the biggest problem? Mattress manufacturing isn't a unique business. Customers don't care where they buy a mattress from. They care about price and comfort. According to analyst Mark Pagitti, the sleep industry is a prime example of how investors pour money into businesses chasing growth at all costs and end up with nothing. Eventually, they realized they weren't funding a business. They were funding someone's dream. In 2022, the company that was once valued at $1.1 billion sold for just $300 million. After that, Casper went through major changes. Co-founder Philip Krim left, and the company was taken over by more pragmatic leadership. Canadian stores closed, the European market was abandoned, and 40% of the workforce was laid off. Their generous 100-night trial was cut down to 30 days. In 2024, Casper was acquired by Carpenter Co., the largest manufacturer of polyurethane foam. The new owner refreshed the product line, expanded offerings, and received positive reviews. But at the end of the day, all that's left of the revolutionary brand is the name. And here's the kicker: Casper isn't an exception. It's the rule. The Silicon Valley playbook: come up with a revolution, build the hype, attract investors, grow at any cost, go bust. And guess what? This cycle is repeating right now. But instead of mattresses in a box, it'll be AI for pets or blockchain for toothbrushes. Investors will believe, journalists will write glowing articles, founders will become stars, and then, boom. A couple of years from now, we'll see another Casper. History loves to repeat itself. just like the legendary Kirby vacuum, which took over the market with big promises and clever marketing. Startups may be more complex, but the formula remains the same. An exciting idea, a wave of hype, and blind faith in revolution.